Now, I want to go back in history a little bit to an era that I think was momentous for all three of these comparison countries. The US, starting in the late 70s, underwent an enormous shift, really a paradigm shift towards deregulation and liberalization. But China did so as well, starting in the late 70s and especially the early 80s. We associate that with Deng Xiaoping, pictured on the right with his famous cowboy hat, and Russia from the early 90s, associated with Boris Yeltsin, shown with his megaphone on the left. You may remember we deregulated wide segments of our economy: banking and trucking, airlines, telecommunications, electric power. We cut taxes, and we've continued to, both the personal and the corporate taxes. We weakened the power of labor to bargain for an increased share of the profits. We relaxed antitrust litigation. We cut social protection. The consequence of the reforms in the US, but also in Russia and China, was that with liberalization came an initial spurt of new entrepreneurship, of competition, followed rather quickly by the consolidation of industries and high concentration of industries and much lower competition. Now, what are the outcomes of these trends? One is a rise in market power. Market power is the term that means the ability of a firm or an industry to set prices rather than to take prices. And with market power comes a firm's ability to extract rents. Rents being defined as the amount of profit that's in excess of what would happen if a factor of production were fully competitive. So as competition goes down, companies can extract rents from consumers and from workers. Now, some economists think the average markup rate in the United States, that is price over cost, may be as high as 35%. If that's the case, it would imply that about 26% of total GDP is rents. Some economists think the figure is in fact higher, and others think it's lower, but it surely is a significant part of the economy. When there's market power within the firm, the owners and top executives of the firm can set wages at a value lower than or higher than marginal product. We imagine, economists would say, in a fully competitive labor market, wages equal the marginal product, the value of the marginal contribution of the worker. But if you have market power, you can lower the wages of those at the bottom end, and you can raise the wages of those at the upper end. And I believe that's what we have seen in the United States. Now, it's very unequally distributed, like so much else in the economy. There are some firms with enormous rent-seeking capacity, some industries, and those are the industries with the lowest competitive pressure. We also have, through policies and laws that favor companies over workers, lower counter pressure from workers. And then, of course, in the political system, which is ultimately what we care about in this democracy deep dive, the consequence is that we get a political climate that reduces party competition, political competition, electoral rights, political equality. We also see in this climate, and the same in all three countries, the privatization of what had been public goods. Also a powerful consequence, and I'll come back to this, of high inequality in all three countries is lower mobility, both social and geographic. It means that inequality in the present is more likely to be reproduced over time. Certainly, it also locks in the advantages of certain regions over others. So the economists used to think that convergence of economies over time was an iron law. That's something our colleague Larry Summers spoke of decades ago. Well, there's an iron law of convergence. Poorer regions will get richer. But that isn't the case if you've got inequality such that factors don't flow freely. And then you get this inequality of access to opportunity that makes advantage and disadvantage self-reinforcing. We want to entertain two objections which are very common when we talk about inequality. The first is, but isn't inequality the natural outcome of the market? There's the theory of skill-biased technology change, which favors capital over labor, skilled labor over unskilled. This is expressed in a very powerful and important book by Golden and Katz, two of the Harvard economists, who spoke of the race between education and technology. And they showed that the premium to skill has risen. That is one very important economic argument about inequality. And of course, globalization bringing this hollowing out in the middle as routine jobs and many manufacturing jobs get outsourced. You have a polarization. You have more jobs at the low wage level and more at the top. And this is one reason we are seeing a shrinking middle class in America. And there's a theory about why the people who are at the very top are getting more. One economist talks about the market for talent. Well, a number of economists say, well, there's a market for talent. And it is the case also that innovation is driving some inequality, as we see with these tech giants that through their digital platforms are able to achieve huge economies of scale. And if you were the first mover like Amazon with the one-click shopping, you can get enormous positive network externalities and early mover advantages. And those are all genuine drivers, I think, of the gains in incomes at the very top. But they aren't a sufficient explanation, and I will explain that in a minute. Then you also have an objection. Why care about inequality? Well, the fact is inequality does matter in and of itself. Market forces can't explain these big differences between the US and Europe, like Germany or Canada. They're equally exposed to technology change, and they're equally exposed to globalization, indeed more so. But in wage trends and CEO pay, they don't have the same growth of concentrated incomes at the very top and the same stagnation of incomes at the very bottom. Another reason to care, of course, is that these differences in the way opportunity is distributed become self-reinforcing over time, within a lifetime and across lifetimes, across regions, across neighborhoods. There's also a larger point, and no doubt you touched on this in your earlier session with Ashutosh Varshney. Where does social cohesion come from? It comes from people feeling that they're alike, they're like other people. And if I feel I'm not like you, I don't so much care whether you're treated fairly or not. We already have problems of social cohesion in the US as a result of our deep, deep racial divisions and many other divisions in society. But inequality exacerbates them. And it's one of the forces fostering our political polarization, partly because it exacerbates fears of redistributive conflict. Look at this ferocious defense against these, what do they call them, radical, socialist, liberal Democrats, who, if they come to power, are going to raise your taxes and take away your property. I think the fear, that very vehement and emotional fear of redistribution, is driven by the very high inequality in our economy. It doesn't have to be this way. After World War II, Germany also had to adopt a market economy, not after socialism, but after Nazism, where the economy was heavily concentrated, centralized, militarized. They had to create a whole market infrastructure, but they did it without creating oligarchs and inequality. Same after they reunified after 1990. There are no oligarchs in East Germany, unlike many of the other post-communist countries. Why not? Because their market reforms occurred in a political environment that was dedicated to ensuring both competition and social justice. So the broad point I would want to leave with you is my firm conviction that when we open up markets in a society, people don't enter the market as equals. They enter the market as part of an existing social structure, a hierarchy in many cases.